we invest across every single discipline. And one of the unique abilities of Carlyle is its abilities to work with portfolio companies, act in many ways as a catalyst, and use its whole network of relationships, investee companies, etc., to make a difference to the portfolio companies. We are very committed to both our LPs and our portfolio companies, and we work very, very well with them. We invest literally in every sector that you could think of. We have multiple funds which invest across geographies and across sectors. Thanks. We have almost 1,000 employees in 27 offices around the world, and we have about 1,300 LPs. The third slide is a disclaimer. Fine. So we'll come to the topic of the day, which is PE trends in India. See, in Carlyle, we broadly see, if you see what's happening in India since the early 90s, when reforms were unleashed, there are two broad trends. One is the need in OECD countries to increasingly give a better product or better service to their customers at a cheaper price and at the same time grow their earnings. So countries like India have developed a lot, and you have seen world-class companies emerge literally out of nowhere who give a product or service to these OECD companies, transnationals, multinationals, etc. And and we see a couple of $100 billion coming broadly, loosely under what I call outsourcing. It's not just IT or IT-enabled services, but it could be generic pharma, it could be contract research, it could be contract manufacturing, it could be textile, it could be auto ancillaries. Now, this acts as a huge multiplier on the domestic economy. India exports are 17, 18, 19% of GDP, but this kind of growth and this kind of need that is there, and because India is a knowledge economy, does act as a crucial multiplier in the economy. So you'll see a lot of domestic sectors like domestic consumer spending, consumer durables, domestic infrastructure, domestic healthcare. A lot of domestic businesses grow as well. And you'll again see, world-class companies emerge in the space. So as private equity investors, we broadly try to find people who think would emerge in two of these broad themes and really become large firms. So we essentially look for companies that already have a track record of profitability. So we don't invest in early stage companies, on business plans, regardless of how talented the management team is. And as a team, we spend a lot of time with the entrepreneurs, because I've been doing private equity since 1993. And broadly, if you see whatever the business is, once the business is broadly good, as a private equity person, we are not investing in a company or a business, but we are backing a person. So we look for two essential attributes. One, he's got hunger and drive. He works 24/7 and is very passionate and committed about his business. And the second is he has a great level of integrity, because at the end of the day, if that is not there, the chances, even if the business does well, that you would get the short end of the stick is very, very high. Indian private equity market for investors is challenging in some ways, because the classic private equity theory is the so-called public-private arbitrage, where private companies are supposed to be cheaper than public companies. That certainly isn't the case in India. We have 7,000, 8,000 listed companies. Apart from the top 100, 150 stocks, there are a lot of stocks that have probably gone to market very prematurely, are tiny, quote at low kind of multiples. And you would normally expect when people want to raise private equity money that valuations would be reasonable. As a platform in China, we still find a lot of deals on that kind of valuation basis. The other challenge in Indian private equity comes is, like I mentioned, I've been doing private equity for 17 years. I've never found a single guy come with a business plan where he says he'll grow his earnings 20% or 25%. They all grow at 50, 60, 100%. And which is how this whole phenomenon of ratchets have happened, because most of these plans are very, very optimistic. They're contingent on a lot of things going right. And normally, if you ascribe probabilities to each of the events, you end up finding a very, very low probability that they would achieve those things. And then that gets compounded, because based on that base, they've made really, rosy kind of projections. So the key thing as a private equity person is probably look for companies that have quality in terms of uniqueness of their idea, in terms of it serving a critical kind of need in the two broad themes I listed. 3, building some kind of franchise value, either based on their knowledge, in base of the competitive position, something unique that they have an advantage. And that backed with passionate entrepreneurs with integrity, you would really have a successful investment to make. I am personally very, very optimistic of the future of the country. If you travel around the country, you would see a very, very discernible trend. I think the kind of gut-wrenching poverty you used to see in 80s, etc., is going. In spite of, this whole cloud, if you see the news channels, corruption, this, that, etc., I still, retain a very, very optimistic view. Partly, our demographics are very good. You have young people, who are getting greater incomes, greater propensity to spend, greater savings. Second, I think since 91, across the political spectrum, left or right, we have a broad framework, which the foundations, the necessary things, a good security market, very good regulators, etc. So as private equity professionals, I think the trend, both for the funds as well as companies, would be to go more to quality companies, quality GPs. So the outperformers would be, funds that are really focused, identify very good companies, and build very successful track records. Thanks.
Okay. Yeah, please. Okay. Good morning, everybody.